let's turn our attention to one of the most influential studies ever written about Warren Buffett's stock picking strategy, Buffett's Alpha. Researchers at AQR Capital Management analyzed Buffett's returns using the same kind of factor models we've been discussing. Their findings, published in the Financial Analyst Journal in 2018 and first circulated years earlier through the National Bureau of Economic Research, have become the go-to reference for understanding what really drives Buffett's success. Here's a fun little connection. Eugene Fama, the Nobel laureate and professor at the University of Chicago, had a PhD student and teaching assistant named Clifford Asness. Asness went on to become a hedge fund titan and founded AQR. And at AQR, they like to say they sit at the intersection of technology, data, and behavioral finance. In other words, they know a thing or two about crunching numbers to make investment decisions. Similar to our earlier videos, AQR also found that Buffett's performance was highly unusual. When you stack his track record against every other equity fund manager with at least 40 years of history, Buffett's information ratio, basically a risk-adjusted measure of consistency similar to the Sharpe ratio, jumps out as a major outlier. So what did the authors of Buffett's Alpha actually find? They concluded that Buffett's performance could be explained by exposures to the market, to value stocks, to low volatility, and to high quality. That's broadly in line with our own findings, though AQR defined quality as company fundamentals like profitability, stability, and low-risk business characteristics, which overlap with the profitability factor in the Fama French models, and with our own consumer non-durables industry exposure. Now, AQR didn't just use the Fama French data library. They built their own proprietary factors, especially for low volatility, to avoid issues like multicollinearity. But the big picture is the same. As you add more explanatory variables, Buffett's alpha shrinks and loses statistical strength. In AQR's table, you can see alpha decline from over 13% to just 5.4% annually, with the T-stat dropping to 1.55. Still, that's far higher than the residual alpha we found in our own final regression model. So how did AQR account for what was left unexplained? They found that Buffett set himself apart by amplifying his exposures with stable, low-cost leverage. Specifically, Buffett systematically bought companies that were cheap, high quality, and low risk. Then, by using insurance float, effectively borrowing from Berkshire's insurance operations, he added modest leverage to scale up the strategy. While the rest of us were paying sky-high rates on margin accounts, Buffett was quietly borrowing from Geico. This matters because it highlights a blind spot: leverage, especially the stable, low-cost kind Buffett used, doesn't show up in the regression coefficients, yet it played a critical role in his performance. So in the end, AQR found that Buffett's success wasn't luck, wasn't magic. It was disciplined, low-cost leverage applied to the right kinds of stocks, the kinds regression models struggle to fully capture. Here's how the insurance float works. Insurance policyholders pay premiums up front, but claims are paid later. That gives Berkshire a pool of capital to invest in the meantime. And unlike debt, this float often costs nothing, sometimes even less than nothing. Buffett then invests that capital, and the returns compound over decades. With float, Buffett wasn't paying margin rates or facing margin calls. What makes this unique is that float isn't like a margin loan from your broker. With margin, you're paying high interest, you can get hit with margin calls, and the financing can disappear in a crisis. Buffett's float was different. It was stable, long-term, and sometimes even negative cost. That gave him a huge structural advantage over other investors. And the scale of this advantage was massive. Buffett wasn't just making magic with stock picks. His insurance float started small, $39 million in 1970. By 2000, it had surged to nearly $28 billion, with a B. A decade later, nearly $66 billion. And by 2011, it ballooned to $70 billion, larger than the equity base of most insurance companies. More than just numbers, that float was like a permanent, cost-free loan he could invest with compounding effect. That gave Buffett a source of leverage that very few others could ever replicate. You'll recall from part 2 of our Buffett series, after testing Buffett's returns on all the Fama French factors, and even including the extended factor universe, there's still an unexplained alpha, about 0.17% per month, or roughly 2% annually. That edge wasn't just about picking good stocks. He picked them systematically, then scaled them with leverage that was both cheap and durable. To fully explain away this residual alpha, you'd need both factor exposures and Buffett's unique financing structure. At the end of the day, Buffett's edge wasn't magic. It was smart factors, paired with smarter leverage. So maybe you can't be Buffett, but with the right factors, a discount brokerage, and enough float, you might just pass for his intern. And that's the real secret behind Alpha Man. If you missed our first Buffett video, click here to catch up on how we set the foundation for this analysis. Or if you're curious how Wall Street's quant funds use data to rank stocks, that video is right here. And if you enjoyed this one, don't forget to like, subscribe, and join us for more insights on money and the markets.